Welcome to the Self-Storage Insight Podcast. I'm Ben Shirey, and today I'm joined by Jeremy Friedman with Stoic Equity Partners. This podcast episode is brought to you by CC Storage. CC Storage is a property management software that has dual pricing built into it, so you can pass the fees for your credit card processing directly onto your tenant in a compliant way in all 50 states. Check out ccstorage.com to learn more. And Jeremy, if you don't mind giving us a little bit of your background on how you got started with investments in self-storage as well as other commercial real estate.
Yeah, certainly. So my partner, Grant Reeves, and I started Stoic Equity Partners in 2020. He and I were both commercial real estate brokers for years and known each other for a long time, worked at the same firm before, and had always wanted to get to the principal side of things. And so in 2020, when COVID hit, the phones stopped ringing for a brief moment, gave us about 30, 45 days to really put the plan together for Stoic. We started Stoic in 20 and did our first deal, closed on our first deal in 2021. And that was an acquisition. We bought an old grocery store box that was currently being used for offices, which were not being used due to COVID. We were able to buy the property, get the tenant to buy out the remaining term of their lease, and use that equity to convert it all into climate control self-storage. Since then, we've done 3 other storage investments, and then we pivoted to flex industrial, multi-tenant value-add flex industrial. Currently, Stoic's portfolio is 13 properties, 88 million in total assets under management, a little over 800,000 square feet, and $30 million of outside equity that we manage.
Okay. Awesome. And so I'm assuming that you're looking as far as building a fund to invest in more commercial real estate investments.
Yeah, so exactly. We started all the first 10 investments that we put together were all syndicated, specific asset investments that we syndicated with check sizes anywhere $50,000 and up. And so our average check size in there was about $200,000. So we had some $1 million check writers, some $50,000 check writers.
Sure.
We did the first 10 assets that way and decided to pivot to a fund model. Mainly for us, the fund model was driven. The reason to pivot to the fund model was because we were having issues where we would try to talk to new investors and bring them into our orbit, but we wouldn't have a deal for them to invest in. And then we would bring out a deal, we'd send it out, and the same usual suspects would come in and commit to it all, and it would get gobbled up. And so it was really hard for us to expand our investor base. And so we switched from doing a 506B offering to a 506C, changed it to a fund model so that the C gave us the ability to go out and do some marketing to people that we didn't already know.
Right.
And then the fund model gave us like this kind of permanent vehicle to be able to raise money into. So This last 3 assets that we've just recently purchased are part of the Fund 1 that is still open. We're still raising money for them. We're still deploying that equity for, and it'll stay open until almost the end of this year.
Sure. Okay. And yeah, before we jump into kind of the nitty gritty of the investments and kind of how the deals look and that sort of thing, as far as investing in a fund like this, do you need to be an accredited investor or as far as what is your credentials need to be look like for there to invest into the fund?
Yes. So we only deal with accredited investors. The 506B offerings that we did prior to the fund allowed those investors to self-accredit themselves. So they were able to fill out a questionnaire, check the box saying, yes, I'm an accredited investor. but before we could market to them, we had to know them, right? So we had
Right.
to already have a relationship with them. Our very first investors came from our commercial real estate brokerage days, really. So I brokered mainly single tenant net lease retail properties, but to investors. And so those same investors, a lot of those same investors are who were investing in our initial early deals. When we shifted to the fund and we shifted to the 506C, it is still all accredited investors only. However, now we need a third party accreditation on them. Because I guess the SEC says, well, if you don't know them before you offer this, you need to get a third party to accredit them.
Right.
And so we use a service called accredited.com, and I think it costs us, if I'm not mistaken, $75 per investor. They give them an accredit. The investor gets with them. We don't have to see their financials. We don't have to review, get into any of their private business. They share whatever accredited says, hey, we need to see this or that. They share it with accredited. Accredited sends us a letter that's good for 2 years. So even subsequent investments, they can still use that same accreditation letter and or use it with other investment vehicles if they want.
Right.
And we've had some people come to us and they already had an accreditation certificate. Another easy way, they also can get their CPA to write a letter saying, hey, this person's accredited. We can accept that as well.
Okay.
But all accredited, yes.
Yes. And the reason I bring that up is, again, some of our, the people that are looking to invest aren't really sure what all goes into that process, right? So, depending on the fund or the syndication or how you're going to invest your money, typically you're going to have to provide some proof of how much money you have to be able to invest into these things. And so just so they can kind of be aware of what does that process look like to make sure I have the paperwork submitted to be an accredited investor. So it's good information.
Well, and so accred, depending on their first contact with accred, there's some quick, easy ways that they could easily prove it, right? So if they had a Schwab account with $1 million cash sitting in or a liquid sitting in it, they could send them that statement and that's all they might need.
Right.
Or if they're basing it off of income, a copy of their tax return, and then they would have what they need. So accredited kind of does an initial consultation to, hey, how are you accredited? And then they kind of say, okay, well, this is the best way for you to prove that. Send us this document. They look at it. They get the letter. We never have to see all that. So it's a good, they're a very trustworthy source. There are others out there that do accreditation letters, but we chose accredited
for sure. And so when you're investing in a fund like this, or like what you guys are setting up, how much information do you give, I guess, because you can spend that fund on different assets, right? As far as you can purchase whatever asset you might feel would, be the best investment for your business. How, as far as the investor, what type of information do you give them as they invest in this fund? Do you just kind of predict growth of the fund or, return on investment, or what does that look like for the investor?
So we, in our initial fund documents, we kind of defined a box and said, hey, all of the properties that we buy will fit into this box. And this box has to do with geographic location. For us, we've defined it with geographic location, what we call the SEC region, or the southeast of the U.S. It has to do with size. So we will not buy a property below 20,000 square feet. Really, probably we won't buy one under 50, but occasionally we'll buy, say, a 20,000 foot property if it's in a market where we already have other properties. But we say, hey, we won't buy anything under 20,000 square feet. Overall, the fund returns we are targeting are, and I'm not, are 15% IRR and 8% cash on cash. But that means that some properties will have, because we do value add, some properties will have a lower cash on cash and we have a floor there. We like to say, hey, we won't buy anything under a 5% cash on cash. But that might have a 18 or 20 IRR to it. But and then we may have some that are say 7-8% cash on cash, but they're in that 15-16% IRR. So we kind of build the portfolio that way. But we define the box that way and say, hey, we're going to only buy properties that, a minimum of 4 tenants. Again, this is multi-tenant, value-add, flex industrial. And then what we did when we launched the fund, we already had the first asset under contract. So that was helpful.
Okay.
People do get a little funny about a blind fund and not knowing what's going into the fund. At this point, we've closed on 3 properties. We have, a significant amount of the fund already placed. So, it's really easy for them to look at the current portfolio and the fund and say, okay, this is what these guys are buying, right? So,
right.
But yeah, that's how we did it. We defined the box, and we also had the first asset under contract.
Okay, awesome. And so let's talk about maybe the crossover. So you started out with self-storage, and you have a couple self-storage facilities there that your company owns and manages, and then you transitioned into the flex industrial. So what kind of crossover is there between those two assets? They're both commercial, but there's a lot of differences and some similarities. What would you say some of the similarities are between the two?
So what we loved about self-storage and love about flex industrial is the multi-tenant aspect of it, right? So I think I mentioned a minute ago, I was in the brokerage world. I did a lot of single tenant net lease retail properties. Well, when that tenant gets to the end of their lease, there are challenges with the value of that property at that point, because so much of the value of the property is put on the cash flow. With a multi-tenant property, with storage, with flex, we have people moving in and out all the time, right? And so it doesn't, we plan for that. We have general vacancies built into our model. We have turns and rollover, we have turns of tenants, so we have downtime and TI and leasing commissions and all built into the models. You don't have TI and leasing commissions in self-storage models, but it's very similar. In other words, we have a general vacancy built in and all that. So we love that multi-tenant aspect to the cash flow. Very dependable cash flows, very resilient cash flows. If there is some pressure in the market and some people have moved out, that's typically we're still all safe there. So we love that. Some of the main differences are is length of the leases. So self-storage is obviously a 30-day lease, which in a rising rate environment is a fantastic thing. It gives you the opportunity to price to market. If there's downward pressure on rates, that's not necessarily the best thing in the world. Although I will say we tend to move our street rate down on units, but not necessarily our in-place units down in self-storage, just because there's a significant barrier to those people having to move. And we love that about self-storage. People tend to not want to move out and move all their junk around, right? So,
right, for sure.
In the flex space, we're dealing with a minimum 1-year lease. Usually we're dealing with 3 to 5 year leases, which is good and bad, because in a value add scenario, when we buy the property, we're going to add value one of 2 ways. We're going to either increase occupancy or increase the rental rates. And usually it's both. But if the tenants have leases in place, that has kept us a lot of times from being able to buy properties because they're too long of leases in place at below market rent. We don't have too long of a time period before we can reprice rents.
Right.
So we look at the WALT, the weighted average lease term of those rents, and when can we start repricing rents. But once they're in place, that's an advantage. And once we've got new market rents in place, that's an advantage. We typically build into the leases increases, annual rent increases, 3 to 4% depending on which market we're in, and then that helps us stabilize the property.
Mm-hmm.
So that's one of the big differences. The leasing is different. We typically are paying a leasing agent a commission. Oftentimes we're having to do some tenant improvements. So maybe we're freshening up office space or adding additional lighting or power in the warehouse, whatever that tenant needs. And that has been a real strategy for us that's worked. A lot of these existing owners don't like spending tenant improvement money.
Mm-hmm.
And so, because they're taking it out of cash flow, usually at that point, they've owned it long enough, there's not, money sitting there to take it out of. We underwrite on the front end and reserve a lot of reserves for tenant improvements and leasing commissions.
Okay.
And so for us, we would rather do some tenant improvements and sign a higher rental rate, higher lease rate, because that helps us when we go to sell the property in 4 to 5 years. We typically we're doing a 5-year hold on the industrial property. So.
Right. So as far as, and I'm sure stabilization's a little bit different in that space as well, but like in self-storage, again, a lot of the strategy comes from like getting people in the door. We have to fill the units. And so then there's always this game of like a race to the bottom of who can have the lowest street rates, who has the best move-in special to fill their units and then increase rates significantly. Whereas on the flex side, it seems like it's more of a typical lease period where you're going to put some money into the front end to set the rental space up for the tenant, and then they're going to be there for a longer period of time. So you're not quite as worried about bringing people in as quickly, right? The turnover obviously is going to be a lot slower. What does it give you a lot more? Does it give you a lot more buying power or flexibility when you're looking for different types of facilities this way, where, instead of just looking for self-storage space, there's a lot more opportunity in the commercial real estate space for these types of purchases, or what does that market look like?
Well, so we did 4 different types of self-storage deals. We did an adaptive reuse of Bell grocery store box. Mm-hmm. We bought a Core Plus property, that was very stabilized, but had value, had room to raise the rents. Mm-hmm. We bought an existing facility that we then tripled in size by adding 2 more buildings, and then we did ground up development. But other than that Core Plus property, really the focus there on all those was in extreme value add. And what we found is that was really the only way we were making numbers work, is if we expanded the facility by 3x, or if we built a ground up development in a fast growing market, or the adaptive reuse. It wasn't so it was really difficult, and that was at 4% interest rates, right?
Right.
So when the rates started rising, we just could not be competitive. We would underwrite deal after deal. We would, submit offers and just could not make deals work. And even these like extreme value add deals, we could not make them work. And so we started looking at the flex industrial side of things, and that, I will say, grass is always greener on the other side of the fence. Mm-hmm. When we first got into that market, we thought, oh, they're everywhere. There's deals everywhere to be found. Surely, look at all these deals, right? And of course, the devil's in the details, and you start drilling down in them, and you find that not every property that's on the market is a deal, right? And so it certainly got much harder And it seems that competition is continuing to increase in that market. So, it keeps getting harder and harder to make those deals work. But what we have found over and over again is that the supply is really low. Nobody's built much flex industrial over the last 3 decades. Matter of fact, it's actually shrunk in supply because a lot of it's been reabsorbed or redeveloped into other types of property. It's hard to develop it because of NIMBYism. People don't want it in their backyard, but also because of the numbers. I mean, rents are low. I mean, it's not uncommon for us to be signing an $8-9 square foot rent. That's per year rent. Somewhere in that $8 to $12 range is where most of our stuff lands. To build a new facility, you probably are going to have to be closer to $16 a square foot.
Right.
So that's what we like, is that moat of it's hard for new supply to come in, and if new supply comes in, they will, which we do predict will happen and need to happen because there's a strong demand and a low supply. That when they come in, they'll be at these higher rents, and they'll help bring our rents up as well. So we feel like it'll be accretive to our values and not be a problem. So that's kind of we just really feel strongly about that. And a lot of these facilities are sitting there with legacy owners that don't want to rock the boat and push rents. They don't want to spend money on the facilities to help try to get higher rents. For us, we underwrite that on the front end, and we bring in money for renovations, for deferred maintenance and CapEx work, as well as tenant improvements, so we can help bring those rents up.
How long from the time that you bring a facility on, or that you purchase a facility, till you have renters starting to use the facility or sign leases on it?
Well, so typically most of them are somewhere between, say, 80 and 100% occupied when we buy them.
Okay.
So, first thing we do is we go in and we identify which vacancies are right for us to go in and do some improvements on. We've had a real good success at going in and ripping out some office space. What happens a lot of times, again, these legacy owners, there's back in the early 2000s, office space brought more rent. People were doing the heavy build out of office space in these units. And so it's nothing to go in and find some that are 80 to 90% office. And the market's really wanting somewhere between 20 and 50% office because people need that warehouse. And so we can go in and rip some of that out and kind of turn it back into more traditional flex. And typically the demand is there for that product. It leases up pretty quickly. And then as far as the existing tenants go, we're stuck with those leases. So if they have options, we're always careful to see what renewal options leases have in them and how we're going to underwrite that. But as leases come up, we present the tenants with the new rental rate, new market rent, and hope they stay at the new rent. But and some do and some don't. And it depends. There's some markets that we're in that not to sound predatory, Benjamin, it probably will, but there are some markets we're in that, quite frankly, there's nowhere else for them to go. So they either need to figure out how to work the rental rate into their new business plan, or it's hard to find another option.
Yeah.
It's very, very, very tight supply. Which is kind of the opposite of what we're seeing in all of our storage facilities. We've had lots of people come in around us, a lot of supply. They're in all fast-growing markets, so we feel comfortable that it'll be fine in the long run. But it's fairly rent growth is stagnated or actually negative in most of our storage facilities at the moment. It's that race to the bottom you're talking about. I have
Yeah.
a theory about that. I believe that, just a couple of short years ago, only the REITs had revenue management software and were out there dynamically pricing their units.
Right.
Now, almost everybody of any sophistication has some sort of revenue management program in place. And, if my facility looks at the one down the street and their 10 by 10 rates 120, we're going to be 110 or 105, and then they're going to look back at us and go, oh, they're at 110, we 199, and then we look at them, oh, we got a 95, and we keep kind of pinging off of each other and racing to the bottom, which I think is dangerous for the industry, honestly. And then we're seeing it, with negative rent growth over the past quarter. There's a lot of reports coming in. So I think it'll all work out. We like storage and want to get back into it, but the timing has not been there for us. We would really like to flesh out that portfolio.
Yeah, and I'll jump back to some other questions I had there, but on the race to the bottom there too. I mean, the one thing that always concerns me is like, if all of a sudden regulation, like the government looks at it and says, oh, you guys are charging, $40 to move in, and over the course of 6 months, you're now at 160 or 170 because that's where you need to be on that 10 by 20 unit. And they say, you guys can't play that game anymore. Well, that's going to affect it a lot. And I think that that's going to happen at some point. I don't know how soon that happens, but typically whenever price gouging starts to become a thing, and it hasn't, there hasn't been as much reporting and stuff on this in the past years. I thought there probably would be, but if you look back to 2022, 2023, when nobody could leave their units, there were starting to be news articles on people paying $250 for a 10 by 10 at, some of these REIT locations and talking about their price raises. And so that kind of publicity was starting to circulate. And then all of a sudden there was availability so people could move across town and get a different unit. Through COVID, everybody was 100% occupied and you couldn't leave. So they were just really taking advantage of it. So maybe that's where that played in more and it won't become an issue, but I definitely think it brings some negative light to the industry for sure when everybody sees a really low move-in rate and then rates getting jacked up. So I really don't like that game at all. And so, but it is what they're playing.
I don't think the tenants like that game. I mean, no. Unless they're a short-term, just in there for a couple months kind of thing.
Right.
But that's the other thing is those just in there for a couple of months during a move, a lot of those people are not around right now. I mean, interest rates for mortgages have gotten so high that, people or most people are stuck in their home at a, 3 or some 3 handle mortgage rate.
Right.
And they can't necessarily sell without buying a lesser priced home at a higher interest rate. It's a smaller house. So there's not as much demand right now in storage. There's been a lot of supply, as we know, and so it's been tough. But
So what type of tenants do you normally pull into a flex industrial when you're leasing it up?
Yeah, so it's a lot of service-based companies, so pest control, HVAC contractors, engineering firms. There's we have several, maintenance companies like elevator maintenance company or those type of things. Somewhere where they need like some office space to run the business out of, but they need the warehouse in the back for parts and product. But we have several last mile logistics companies. We have. Again, back to we're a pretty low cost provider in the market. So it's funny, you'll get all kinds of stuff in here. You'll get a real estate office or recently a salon going into one of our nicer facilities, well positioned in the market. But so, it's a little bit of everything, but primarily it is service-based, companies. It's some life sciences, and it's some logistics, some last mile logistics primarily.
Yeah, so pretty diversified group of different business types, and yeah, that's awesome.
Yeah, home healthcare companies, pharmacy, like mail order pharmacies. We have a few of those. So I mean, it's just we've got a mail order or a golf club rental company that ships golf clubs to people going on vacation
Okay.
and things like that. So it's just a lot of different stuff. But
Have you been seeing, pretty significant growth since the markets have been coming back to normal as far as, workforces, I guess would be the better word, coming back to a more normalized sense, since we've kind of gotten out of the COVID shutdowns and all of that stuff. I mean, there was a lot of like call centers in our local area. There's several, large spaces that had call centers in them, and those people all work from home now, and they don't need that space anymore. Does it seem like that's kind of given you an opportunity to get these facilities and then also be able to fill them up now with new business types?
well, it's interesting. I won't say that I hate using the word like COVID proof, but what we have found is that the majority of these type tenants never did go work from home, right?
Hmm.
So it's kind of like if you need a warehouse, it's really hard to go work from home. And
Right.
so that being said, we have had some. Recently, we had a freight brokerage company that they shuttered they did not renew their lease, and they all went to work from home. But we're not necessarily seeing people come back from that either, because again, if they needed a warehouse, they really weren't working from home. So,
Hmm. Sure.
um,
That makes a lot of
it's,
sense.
yeah, I mean, I won't call it COVID proof, but it's COVID resilient. Come on.
Hmm.
We,
Yeah,
we it's again, it's tough to go work from home if you need to store a bunch of HVAC,
for sure.
units and such. So
Yeah. So I guess, again, we've been going for a little while here. I just looked up and I was like, oh, wow, the conversation's been going on for a little bit. Very interesting. Is there kind of like one piece of advice you'd give to someone who's looking to invest in a fund like this? Maybe a question they should be asking the company they're looking to work with?
yeah, from an investor standpoint, I think it's it's very important to understand the team that is managing the assets, managing the business, as well as the strategic partners that are. So for self storage, that could be if there's if the syndicator or a fund manager is um, actually managing the property. What is that? How do they do that? What's the team look like? What's their experience there?
Hmm.
If they are like, we use third party management for all of our assets, both flex and self storage. Who's that? Who's that partner? Who's that strategic partner?
Right.
Who is responsible for the books? We have two in-house accountants. We have two staff. We have a staff accountant and accounting manager. And so we have a full-time asset manager, director of asset management that deals, even though we have third-party property managers, we have to manage those managers. We have to be the squeaky wheel to make sure that
Hmm.
leasing and property management is handled to our standards. And so what does the team look like? I think that's probably the biggest thing, and what's their experience level. Can you get comfortable with that? Because at the end of the day, there are ups, there are downs. Insurance rates will go sky high, or whatever the challenges that they're inevitably will come up. It's the team that you're investing in that will get you through that. And so I think to
Right.
me, I would say really evaluating the team, their abilities, their uh, core abilities, and both internal team and strategic partners.
Awesome. Yeah, that's great. Great advice. And yeah, thank you so much for your time today and sharing a little bit about your company and kind of where you guys are at and where you're heading. If somebody wants to get a hold of you and kind of ask some questions or learn more about Stoic Capital, how do they get a hold of you?
So easy, we're at on the web, we're at stoicep.com. So STOICEP, that's for equitypartners.com. I'm also fairly active on LinkedIn, and you easily find me there, Jeremy Friedman. My email is jfriedman@stoicep.com. Pretty easy to get on.
Thank you for tuning in to another episode of the Self Storage Insight Podcast. We hope you enjoyed this episode. Just a quick reminder, this episode was brought to you by CC Storage. CC Storage is a no-cost property management software that allows you to pass the fees for credit card processing on to your tenants, freeing up some CapEx space for your business and helping you more efficiently run your storage facility. If you'd like to learn more about CC Storage, click the link in the description below, and we hope to see you again for our next episode.